What is going on, traders? Welcome back to the Traveling Trader. Today I wanted to talk about one of the most important and talked about topics in trading and give my perspective and views on it. Why do most traders lose money? Of course, there's general reasons like experience in the market, ability to read charts, etc. We'll leave those out for now. Those are kind of obvious. And I'm assuming that if you're watching this, you have some sort of trading experience. But believe me when I tell you, I've seen some of these reasons committed by traders of all levels of experience. So number one, knowing the market that you're dealing with, right? Whether we're talking about crypto, stocks, options, every market has a different volatility level. Every market has a different risk tolerance. For instance, the crypto market is known to be swingy and extremely volatile. So gains of 2% or 3% are usually not satisfactory in the crypto market. However, in the stock market, that is all and well within the parameters. But in the crypto market, you're used to seeing swings of 10, 20, 30, 50%. You're used to seeing coins 2x or 3x regularly. So that is number one, knowing the market you're dealing with. You cannot trade every market the same. If you're dealing in the crypto market, you should know that you're dealing in a very volatile market. Taking profits is a lot more critical in crypto than in stocks, for instance, where you can potentially long-term hold and not really worry about what happens on the day-to-day. Options, for instance, have expiry dates, so the way that you trade them, your strategies, your risk tolerance is gonna change depending on those parameters. All right, number two, now we're really getting into the juicy stuff. Only entering when FOMO kicks in. And trust me when I tell you, this is most individual traders. They'll hear about Bitcoin, crossing 15,000 or 20,000 and they'll wanna get in. They'll hear about, Tesla being at an all-time high and they'll want to jump in. They'll hear about gold or silver being at an all-time high and they'll want to jump in. And usually when the masses hear about it, right? When most of these individual traders who aren't really involved in the day-to-day, when they hear about it, then it's usually too late, right? For those of you that are involved in crypto can relate to December 2017, when a lot of you heard about Bitcoin for the first time, or a lot of your parents or grandparents and we're asking you about it. Now, this is not to be confused with breakout trading. If you follow the trading community that we have, you'll know that a lot of trades we wait for breakouts to happen, for certain patterns to be confirmed before entering, right? This is not the same as FOMO. You're looking at a setup and you're waiting for it to be confirmed before entering. So yes, you're not catching the absolute bottom, but catching the absolute bottom is an exercise in futility. Trust me, you might get it 1 out of 10 times, but it is not a solid trading strategy. Number three, monitoring too closely after entering a trade. After hitting that buy button, you start stalking that stock or that coin, kind of like a psycho high school girlfriend or boyfriend, but monitoring too closely after you hit that buy button, right? The minute you hit it, you see the stock go down, 0.5%, you start panicking and you say, should I sell? What is happening? I just entered. Why does this always happen? After I buy, it goes down. Well, you should know that the stock is moving up, or the coin or whatever asset you're trading, it's moving up and down constantly, right? Before you bought and after you bought. It's just a typical market cycle. As long as the setup is correct and you're not FOMOing and you entered your trade based on sound analysis, just leave it be, set a stop limit. There's no reason to incessantly monitor the stock's incremental movements up and down. Now, monitoring a stock or a coin too closely leads to number four, which is making too many moves in a short amount of time, right? So you see your asset dwindle by 0.5% or 1%. You're like, holy shit, I don't want to lose money. You panic sell. Then it goes back up. You're like, fuck. Then you buy again. Then it goes back down and then you sell. We've all seen that meme in crypto.
Bogdanov, e-book The Deep.
Continuité d'hommes.
Il panique seul.
Temporary bottom, reversal.
Yeah, kind of like that. But that is indicative of real life, which is why it's so funny to a lot of people. Every time you enter a trade, it's as if your psychology is geared to tell you that the market is against you. So anytime you see something move down a blip, you start panicking. Again, as long as your setup is optimal, you have to trust your trade and leave it be. That's the only way that you're gonna win. Because if you panic sell, after you see something drop 1% and then it goes up, you're going to want to buy again. But every time you do that, you're shooting yourself in the foot. All right, number five, trading with money that you care about. Now, obviously you care about all the money that you have. That's not what I mean. What I mean is trading with money that you actually need to pay bills. You should only be trading with excess cash, no matter what that amount is. I know a lot of you sometimes think that you can't make a difference in trading if you start out with a minimal amount of money. I'm gonna be doing a video on this later. How much money do you actually need to be a successful trader? But the point is, trading with money that you actually need is an extreme detriment. It will cause you to make bad decisions. It might force you to panic sell too early. It might force you to take profits too early. I see this a lot of time. Your portfolio distribution is out of whack, right? You think that because you don't have a lot of money, you have to put it all into one coin or one stock. And then a lot of traders that I know actually are trading with excess money, right? Like money that they don't actually need, but they treat it as if it's something dire or sacred, right? They treat it as if it's money that they actually need. And if that's the case, then you need to rethink what you're doing with trading. Sometimes trading is not for everybody. In the same way that gambling in Vegas is not for everybody. Now, I'm not saying that gambling and trading are the same thing, but they're both endeavors that will allow you to lose money, or potentially lose money, right? And so I see a lot of people in Vegas. I've been to Vegas with people who have a ton of money, but are so afraid to put a $25 down on blackjack. Same thing with trading. I've seen people who have tons of money, but they're so afraid to lose what should be insignificant in comparison to their budget or their portfolio. And number 6, the last one, trying to day trade or swing trade when you are much better off buying and holding. There is a certain mystique or allure about day trading, right? That you somehow are beating the market on a day-to-day basis, quitting your day job. But a buy and hold strategy can work perfectly well for you. Just take a look at some of the historical market data. Now, crypto is a very young market. So yes, if you bought at 20,000, which is the all-time high, you are basically assed out right now, which goes back to point number 1, knowing the market that you're dealing with, right? But buy and hold can also work in crypto, especially if you're buying at historically discounted prices like we recently had. There's also a dollar cost average strategy where you're putting in the same amount every 2 weeks or every month on a scheduled basis. You're putting in the same amount into the market. That also brings the average cost of your entry down. I did a video a while back on Bitcoin specifically. If you bought at the all-time high and you dollar cost averaged every 2 weeks, your buying price would be very close to where it is now. That is it for these pointers. I hope that this helped you in some way. I know I'm guilty of at least one of these and have been guilty of it in the past. I'm sure some of you are looking at this list thinking, oh shit, that sounds like me. Trading is more about psychology than knowledge, to be honest. You can be the most impeccable chart reader, but if you don't know what to do when you hit that buy or that sell button or how to set your stop limits up, then all you are is a chart reader. Believe me when I tell you there are tons of people that are really good at reading charts, but when it comes to putting their own money on the line, they freeze like deer in headlights. So trust me when I tell you that trading is more about fixing your psychology rather than having wizard-like knowledge of charts. Buying in the red, for instance, is something that's so counterintuitive to human nature, right? Buying something when it is losing value. All right, the battery just died on me, which probably means that I should be going. Fun fact, there is a seaweed infestation here in the Caribbean. You see it all along the shoreline, it's insane. Anyway, don't be like that seaweed. Make sure you're paying attention to those points when you are trading. I'll catch you guys on the next video. Peace.